Hey, it's Mike Lynch at Cross Country Mortgage, and it's Monday. It's time for your Monday morning mortgage update for the week of July the 31st. Last day of the month, heading into August, school starting in 2-3 weeks. Summer is going by fast. I hope you all had a fantastic weekend. Gail and I spent the weekend on the lake. We just had a nice cool weekend with the hot weather. So let's talk about what happened last weekend, what's going to happen this weekend. I always try to give you tools, tips, tactics, things that you can use when you go out and talk to your buyers and sellers to have some impactful conversations about all the misinformation and the unknowns and the fear and the uncertainty about what's happening in the real estate markets right now. So let's talk about what happened last week. Last week, the Fed met. They have their FOMC meeting about every 6 weeks. They always started on a Tuesday and they always ended on a Wednesday afternoon. And there's a press conference at the end of that meeting, and everybody pays attention to what Jerome Powell says, our Fed chair. And basically he came out and said, we're kind of bullish. We think that maybe we're having an impact on inflation. We're not sure if we're going to raise that rate again in September. And keep in mind, they've been raising the Fed fund rate since March of last year, every single meeting except the one prior to this. Everybody's kind of wondering, when are they going to stop? Because raising that Fed fund rate has a direct impact on businesses, the cost to borrow money, home equity line rates, credit card rates, auto loan rates, the stuff we all pay for. It does not have a direct impact on mortgage rates. Remember, mortgage rates are determined by the trading of mortgage-backed securities in the bond market. And the bond traders pay attention to what the Fed says because that determines how they're going to price bonds and trade bonds. So Fed came out and said, we may raise the rate in September, but we may not raise the rate in September. And the bond market rallied behind that. And we actually saw an improvement in mortgage rates on Wednesday. Why? Because if the Fed thinks that maybe they're having an impact on inflation, then that is positive for mortgage rates. Inflation is the worst thing for mortgage rates. And that's why these mortgage rates have been going up for quite some time. And that's why the Fed's raising that Fed fund rate is to fight inflation. So that was great Wednesday. And then on Thursday, some economic news came out that said, hey, economy's not doing too bad. And that's bad for mortgage rates. And then on Friday, the PCE number, an inflationary number that came out, said year over year, inflation's down, but month over month, it's up. And so really, we ended the week with rates slightly worse. Not really that bad, slightly worse, almost an insignificant difference. So what are we looking at this week? So this week, we're looking at some data, but really we're focusing on two things. We're focusing on all the jobs, and we're focusing on all the manufacturing numbers that are coming out. So big jobs week. Let me tell you what's coming out. Initial jobless claims, private payroll, non-farm payroll, unemployment rate, unit labor costs, average hourly earnings, just a ton of stuff just about every single day that's going to tell us are employees making more money? Are employers paying more money out? Are employees seeing more money in their bank accounts? Are jobs going up? Are they going down? Is the unemployment rate going to go up? Is it going to go down? So at the end of the day, if we see higher wage costs, that's the one thing we're really paying attention to. That's inflationary. That means businesses are paying more out, and that's not good for mortgage rates. If we see a job market that's strong, that means that the economy is doing well, and that's not good for mortgage rates. So we'll really be paying attention to a lot of the jobs reports coming out. Friday's a big one, unemployment and some jobless numbers that are coming out. The next thing is manufacturing. Really, the second thing that's affecting the market are businesses making stuff. So we've been in a manufacturing recession for over 12 months, means businesses have really retracted on making stuff. Some of it has to do with can't find employees. Some of it has to do with they just aren't selling the stuff they used to sell. Really impactful. Are businesses making stuff? If we see that there's a contraction in manufacturing, that's positive for mortgage rates because that means the economy is contracting, and a weaker economy means strong or lower mortgage rates. If we see an expansion in manufacturing, then that's bad for mortgage rates. So we'll be paying a lot of attention to manufacturing. So what are we looking at this week? Very volatile market. Looking every single day really at the jobs numbers and the manufacturing numbers. Pivot to a locking position if we need to. We're starting out floating. So if you know anybody who can benefit from this video, please forward it to them. If you have any questions on the market or if your clients have any questions, don't hesitate to give me a call. Have a great, productive week. We'll talk to you next week. Bye-bye.